Which is the best dividend stock to buy right now? Lowe's, Macy's, or AT&T? I'm going to answer that question in this video, comparing the three dividend stocks across four different financial metrics, and then giving the answer at the end of the video. So you're not going to want to miss that. Stay tuned and let's get started. The first thing I want to look at is the dividend yield. And looking at this metric, you see Lowe's at the lowest at 2.09%, followed by Macy's at 3.76%, followed by AT&T offering the highest dividend yield at 5.98%. Now remember, when you're investing in dividend stocks, you're not only getting the dividend yield, you're also getting a potential capital gains yield. That is the difference between the price you buy the stock and the price you sell the stock several years down the road, or maybe several months down the road, depending on your investment time horizon. But you have two sources of return when you're investing in dividend stocks. So don't get so focused on the dividend yield that you forget or neglect the potential for capital gains yield for an increase in the stock price. The next metric I wanted to look at is annual revenue growth. And looking at this metric over the several years, we have some fluctuations, with Macy's consistently being the lowest, uh, except for this one time after the economic reopening. It rebounded aggressively because it struggled mightily during the lockdown phases of the pandemic. But other than that, it's been Lowe's and AT&T changing between the highest revenue growth. And I would say, if we're looking at, so this looks at the revenue growth for the last decade. If I'm looking at revenue growth for the next decade, I would expect Lowe's to do the best in terms of revenue growth, and I would expect that to be in the mid single digits, something like 5-6% revenue growth over the next decade for Lowe's. For AT&T, I would expect something lower, 2 to 4% revenue growth. For Macy's, I would expect flat-ish revenue for the next decade because of the uncertainty surrounding its brick and mortar locations. Will it continue closing locations? Or will it say that it's at a level where it feels comfortable with how many locations that it has? The good news is that Macy's management has been noticing that areas where Macy's has a physical brick and mortar location, online sales are higher in those regions. You might say, why might that be the case? And I think it's because if you're buying something online from Macy's and you know there's a store close by, you feel more comfortable buying online. Because if you need to make a return, or if you need to make a quick switch in terms of size, you bought a medium, maybe you need a large, or you bought a medium, maybe you need a small, you could go you could drop by and pick it up at the closest store. You don't have to deal with the return and shipping and handling hassle of returning something you bought online. So that's why I think that Macy's might be done closing locations. They might say, you know what, we're happy with how many locations we have. Lowe's doesn't have that problem in terms of its brick and mortar locations. The type of things that Lowe's sells attracts a lot of customers coming in quickly, right? It sells a lot of things that you might need to buy and you might need to have that instant. So let's say you're repairing your toilet, you're going to go to Lowe's and you're going to want that item that instant, right? You're not going to want to wait 2 days to fix your bathroom, right? Especially if you're in a home that only has one bathroom, right? So it's more urgent. You're going to want to go to the store. That means that Lowe's benefits from its brick and mortar locations. AT&T has done a good job of incrementally increasing revenue from its existing wireless customers by adding new devices, right? So if you had a plan with AT&T where you had an iPhone, AT&T will tell you, hey, why don't you add a data plan for your iPad or your Apple Watch maybe. So incrementally, by adding those devices to your plan, it adds some revenue to AT&T, and those come with high profit margins. So that's how AT&T over the next decade, I suspect, will add revenue, is by incrementally adding devices, because the market for wireless devices for cell phones is pretty much saturated, right? Smartphones in the US, it's pretty much a saturated market. The next metric I wanted to compare these three dividend stocks on is the operating profit margin for the trailing 12 months. And on this metric, AT&T is clearly in the lead here with an operating profit margin in the high teens and growing, 17.82% most recently. Next, you have Lowe's at 10.47% and also growing over the last several years. And finally, we have Macy's at 6.65%. And I would suspect Macy's to do better on this metric over the next decade than it did in the previous decade. That's because during the initial phases of the pandemic, Macy's made huge cost cuts, really streamlined its operations, and that's already starting to pay off as economies have reopened. But you're really going to start to see the benefits of that over the next decade. That leverage is really going to start to show up, in my opinion, in Macy's operating profit margin. Now, it's not going to go up to 20% from 6.5%, but it might go to, 8, 9, might reach double digits, 10, 10, 11, 12%, because of those investments in improvements in efficiency the company made with those cost cuts. So finally, I wanted to look at the valuation of these dividend stocks. I wanted to compare using the forward price to earnings ratio. And according to this metric, Lowe's is the most expensive at 13.78, followed by AT&T at 7.591, and finally Macy's at 4.408, a relatively inexpensive stock there. However, if I'm thinking about buying the best dividend stock right now out of these three, I think I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. I think Lowe's is the best dividend stock to buy out of these three because of the prospects for revenue and profit growth over the next decade. I think Lowe's has the best prospects out of these three according to those metrics. And of course, if revenue and profit increases, that's a greater chance of dividend payments increasing and a greater chance of the stock price increasing. So for that reason, I would say Lowe's would be the best dividend stock to buy out of these three dividend stocks. All right, that's all I've got for this video. I've picked out some videos that I think you'll enjoy. They're popping up on your screen right now, so please click on one of those and I'll see you over there. Thank you for watching.